Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager of trading and derivatives education here at Schwab, and this is Getting Started with Options. And it's a pretty interesting environment that we're dealing with out there right now. We just saw the stocks have their worst day in 6 months. We have earnings season that's kicking off. We have political tensions between the U.S. and China. We have what else? It's just October. October has that historical tendency toward bearishness, not always, but we'll see. But there are lots of traders out there, I think, that are very likely considering hedging stock positions, at least educating themselves about that. So I wanted today's discussion to be sort of a beginner's guide to hedging stock positions by buying put options. But I wanted to talk through 4 key considerations that a trader might consider before buying that protective put. It's a lot to cover. We're going to have some fun today. We're talking about volatility and trying to hedge against that. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see so many familiar names. Hello there, Paul and Andrew, Janelle, Lawrence, Josh, Eva, Posh, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy that recording, but be aware that you're invited to join us in the live discussion. If you'd like to be here during the live presentation, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern. Now, I also want to let everybody know that my very good friend, James Boyd, is going to be hanging out in the chats, addressing any questions that I can't get to just during the natural flow of the presentation. James and I have worked together now for more than 2 decades. James, I think just about everybody here knows James. You know that he brings a ton of experience to this discussion. Thanks for having my back there, James. James and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite Schwab presenters there on X. You can connect with James on X at James Boyd CS. You can follow me on X at Cameron May CS. And if you reply to one of my posts on X, I try to reply right back to you. It allows for some interaction. It's not available otherwise when the cameras are not on. So let's get into this discussion. And of course, since risk is the topic of the day, let's talk about risk. Just bear these important disclosures in mind that trading and investing carry risk. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including loss of principal. All right. So yeah, today is it's all about protective puts. So not everybody's going to know exactly what those are. So I want to set the stage with a quick review of what's going on with the markets, look at the sort of risk factors that might be out there and why some traders might be considering things like hedging with puts right now. Then I want to talk about using an example protective put on a current position in our paper money portfolio. So I'm going to talk through what a protective put is, 4 key considerations that a trader might keep in mind before buying a protective put, and then we're going to plan and place a protective put trade on that existing position, place the order in our Thinkorswim paper money account. So a lot to cover. Let's go right to the Thinkorswim desktop, start to knock this out. So yeah, let's do a quick sort of uncomfortable revisit of the last 72 hours of trading on the S&P 500. We're just using this as a backdrop for what a lot of stock investors are experiencing right now. Friday, so today's Tuesday. On Friday, we had this big down day on an apparent increase in political tensions between the U.S. and China. We'll see how all of that plays out. It looks like maybe some of that speech has been dialed down a little bit, and the markets seem to be reacting a little bit with more positivity. But we're definitely seeing more day-to-day movement that may cause some stock investors to be a little bit concerned about current positions. So yeah, this was the biggest intraday down day that we've seen since all the way back here in April. Big swing down. We've popped back up recently, but that's sort of that technical backdrop for today's discussion. We also have just the mere fact that we're in the month of October, which carries kind of a well-earned reputation for volatility. We're kind of seeing that play out before our eyes again here in 2025. But there are other things that can stir volatility, including earnings season. Yeah, the big banks are starting to kick off their earnings announcements really pretty much as we speak. So we'll see how the markets react to that, what sort of volatility that might carry. Now, volatility is not guaranteed, but for some traders, under conditions such as these, their minds might turn to protecting positions, maybe protecting profits, maybe stemming as much as possible additional losses if that's a personal situation. So I wanted to take a look at an example position in our paper money portfolio. So let's have a look here at General Electric. So now known as GE Aerospace. It's operating under GE Aerospace now. But 100 shares purchased at $255.43, current market price $301.37. Let's see what's going on with General Electric at the moment. So let's put ourselves in the shoes of an investor, maybe bought the shares back here at the 255-ish level, maybe before. There are lots of traders out there or investors that might have some substantial profits that have been built into, or that have, let's say we have unrealized gains on existing stock positions. And what might be catching their eye are a number of factors. Maybe they see the stock coming up to highs where the stock has struggled now. Maybe they're peering over the horizon and they see that there's an earnings announcement coming up on the 21st. That's right around the corner. And we know what earnings can do. It can spur additional buying, or it can actually cause some significant selling. Not every earnings announcement results in big moves in one direction or the other, but there tends to be that tends to be sort of more often than not with many stocks out there. In any case, but this is just an example of some of the scenarios when a trader might consider hedging. Not every trader feels the need to hedge. Some of them are perfectly willing to ride out the rough patches. Maybe they have that long-term perspective. Others, if they're really convinced that a stock is about to go through a negative period, maybe they just choose to sell. So what we're discussing today is not the only action that might be taken. However, let's consider those traders who really are thinking about how might we hedge some of that downside, maybe a lot of the downside, if only for a period of time. So let's do that here for GE Aerospace. And let's just say that we are this hypothetical investor owning shares with some profits that have been accrued but not yet realized. And they're staring in the face of an apparent price ceiling. And they're looking at that earnings announcement. They're thinking, geez, it's just October. And also we have this trade stuff going on. I don't know what might happen there. We'll see how it all settles out. But I wanted to build an example protective put for this position and just talk through it. So let's do that. Let's go right to the trade tab. And I want to talk through, as we construct this example trade, 4 key considerations, because there are some elements of protection that a trader might be considering as they're attempting to strike the balance of the cost of the protection and the degree of protection that's offered. All right. So how about we come over here? Let's open up our scratch pad. Let's maybe close up our account information, give ourselves some more writing space here. So our example trade today, our example strategy, is going to be a protective put. And here are 4 key considerations. Mouse out of your way. Number 1 is the length of time that the trader might think they need that hedge in place, or that protection to be in place. So as we look at General Electric, we might think, well, it looks like we're just below that resistance. Either we're going to break through it or we bounce down from it, very likely within the next few days. So maybe we don't need protection for very long. Well, but there's also this earnings announcement that's there on the horizon, maybe a few more days than that. But also October, and I don't know how the trade scenario is going to play out, what impact that might have. How about our traders just looking over whatever it is that has them on high alert, and they want to make sure they get through at least that time frame. Now, for today's discussion, let's say we want to allow enough time to get this resolved, the chart element of our concern. We want to allow enough time to get us through this earnings announcement and maybe a couple more weeks just to see what happens with October and with the current trade scenario. All right. So how about we look out here and make the decision to go out to November 21st. That's going to be the third Friday of next month for the purchase of this protective hedge. Now, regardless of the amount of time chosen, I think we can recognize that the more time we feel we need protection, the more it costs to get that protection. Right? If we just wanted some hedge for the next, let's say, 3 days, that's going to carry one cost. If we want 38 days, that's going to carry another cost. And I'd see we're getting some votes here for whether we have a light background or dark background on Thinkorswim. Some presenters have a preference for one versus the other. It raises a good point. I don't mind pausing the discussion there for just a moment. If you're watching a presentation that doesn't, what you're seeing doesn't look like what you're using at home, it's just because we've changed the look and feel right up here under the application settings. You can go to look and feel and change from light to dark. So you might see some presenters with this sort of a feel. I prefer the light. I'm just going to leave it there. But yeah, other than that, it doesn't change the function of the platform at all. So 4 key considerations: the length of time. If you want more protection for a longer period, it's going to cost more money. And just to illustrate that, if we were to look at a 3-day contract on a put, we might look at, how about we look at with the stock trading right at about $300, let's look at that $300 strike, just for reference. And that looks like that might cost around, I don't know, $3.50, $4 for 3 days worth of protection, versus if we wanted the right to sell stock for the next 38 days at $300, that's going to cost about 3 times as much, maybe around $13. So 3 to 3.5, maybe 4 times as much. Not surprising. We're actually getting more than 10 times the length for about 3 or 4 times the cost. But that's one key consideration when trying to strike a balance between the amount of protection and price. That's a consideration. The 3-day contract period just wouldn't get us through all of those elements that I just laid out for volatility. Eva, you like the best this is the best, you call that this the best background? Okay, I'm going to leave it this way. I would anyway, because it's my preference. It's easier on my eyes, basically. Anyway, but also we need to talk about just exactly, as we move on to our next consideration, which is going to be the strike price of the contract. I want to get into the details of what it is that a protective put delivers to the trader. So how about, let's go to the 21st of November. And for today's protective put, I'm just going to skip to the end. Spoiler alert, we're going to be buying the $300 strike for the 21st of November. So that's what we're going to do, buy. And it's just going to take one contract of the 21st of November because we have 100 shares. We're going to buy the 21st of November $300 put. And that looks like that's trading between $12.80 and $13.20. Let's call it $13. Right? So what this is doing is if we choose to pay the $13 per share, these are standard contracts representing the potential exchange of 100 shares of stock. We're paying $13 per share times 100. It's a $1,300 cost for this protection, this protective put. But in exchange, we now have the right for the next 38 days or through the 21st of November, we have the right to sell shares of GE Aerospace for $300 per share. Doesn't matter how far they fall from here. If the stock plummets on earnings, if it hits that resistance and crashes, if the US and China if things get really tense there, if October 2025 turns out to be the worst in the last 20 years, any of that, if it drags price down, this trader would have the right to sell their shares for $300. That's only $1 below the current value. So you can see that's a substantial degree of protection. Well, if we look at this second consideration here, we could choose a different degree of protection. Instead of locking in a potential sales price of $300, we get the contractual right, yes, to even sell the stock for a higher price if we're willing to spend more money for that right, or if we're willing to accept less protection, willing to sell the stock at a lower price, we could pay a lower premium. Like, for example, we could buy a put at the 290 strike. So the strike price is really, if you want to think of it this way, it's just the price at which the buyer has the contractual right to sell those shares at any time for the time frame of the contract. So in this case, we have the contractual right to sell 100 shares of GE for $300 per share all the way through the 21st of November. Okay, so I see some questions that have come in. Ron Joseph says, wouldn't it be better to do a bear debit spread as a hedge to lower your overall cost? Now, better is a big, big word. And I'm not going to go deep. I'm not going to go into debit spreads because I just didn't choose that as today's topic, and it can take us a little bit too far off track. It would literally just answer, to really do your question justice, I'd have to spend 10 minutes explaining the difference between a protected put and a debit spread. But I will say a debit spread would provide less protection, but also at a lower cost. Anyway, and actually, depending on the strike price chosen, strike prices chosen. So there's a lot to cover there. It's a good question. It's just too big for this discussion. Anyway, another thing that I need to do as I look at the chats is to hit pause on the presentation because I noticed that there's a survey link that's been added here. So if you're here in the live stream audience right now, if you would do me this favor, click on that survey link in the chat. It'll allow you to give me some feedback after the webcast is over. You can give me some honest feedback. But I just want to let you know a couple of things about the survey. First of all, it's extremely short, 2 multiple choice questions, and then a comments box and a suggestion box if you want to fill those out. But the other thing I want you to know is that if you take the time to fill out that survey, I promise you, I will read through that data. I read through those comments, and it's always helpful. It's never a wasted effort to fill out a survey for one of your Schwab presenters. It always helps. So thank you for doing that. But yeah, and Randy's saying, couldn't you construct a collar trade? Isn't that another approach? Yeah, there are lots of different ways that a trader might choose to manage the risk on an existing stock position. But again, collar trade may come at a lower cost, but also, now lower cost just means out of pocket up front. It also imposes an upside reward limit on the trade temporarily. It's not the case with protected puts. So there are pros and cons to each one of these things. They're being proposed by you. So legitimate questions being proposed, potentially legitimate alternate strategies. We just don't have time to cover every single one. And we want this to be a beginner's guide to protective positions. And saying beginner and then leaping to multi-leg strategies, I think would be a little bit step outside would be coloring outside the lines for what I wanted to talk about. Okay, thank you. Anyway, but yes, the trader, as they're considering buying a protective put, might look at the length of time for the contract. They might also look at, well, what price is this contract allowing me to sell my shares for if I need to? At what price are we striking a deal to maybe potentially sell the shares? $300? $310? Higher price, higher cost. $290? Lower strike price, lower cost. Pros and cons. So am I saying in this example that going at the money or choosing the strike price that's closest to the current price is the correct choice? No, that's going to vary from one trader to the next. The nice thing about this strategy, and one of the nice things about so many option strategies, they are flexible and tailorable to a trader's preference. as long as they understand how to weigh the pros and the cons of each of the choices available to them. Janelle, you like that strike a deal? Yeah, that's the way I always think about it. We're striking a deal for the potential exchange of shares of stock. So that's key consideration number 2. Key consideration number 3 is I want to sort of back away and really think about the trader's objective in buying the protection in the first place. This will come as a little bit of a surprise to a lot of people who are hearing about protected puts for the first time, but actually, it's not the trader's objective to sell the shares at the price on the contract, $300 in this example. The protection isn't necessarily there to get us out of the stock, but instead, typically the trader's objective to see the put increase in value if the stock starts to fall in value, and therefore help us to offset that decline in stock value. Right? Yeah, if the stock goes down, typically the put values go up, and that can help to hedge the stock position. Which brings me to my third consideration, which is what I call the initial, not the initial, the initial hedge delivered by the stock. In other words, this is measured by delta. Let's look at this. So if we don't have delta displayed as a column, we can come up to the column headings right up here. The default is just going to be last price and net change. So if your layout looks kind of like this, you can go up here, click on just next to the spread single, click on last X and net change or whatever the column headings are here. And we can choose our Greeks. Because I want to discuss this Greek, our delta. And our delta gives us some good insight into what I call the initial hedge on the contract. We know that the contract gives us the right to sell shares at 300. So it sounds like there's only any protection that kicks in if the stock happens to fall down below 300. That's not actually accurate. There's an initial hedge before that. Look at the $300 strike price that we're considering, and it has a delta of 45 cents. It says minus 45. The assumption of our delta is that price goes up $1. Delta starts with D, so does dollar. It assumes that stock price goes up $1. Well, what if stock price goes down $1 instead of our contract falling by 45 cents in value? If price falls by $1, our put would increase by 45 cents in value. So another way that a trader might look at that is, so on the first dollar move down, we haven't even gotten down below 300 yet. That would actually still leave us a few pennies above 300. We will have had an unrealized loss on our stock of $1, but our put has increased by 45 cents. In other words, on that first dollar move, there's about a 45% protection offered. And if we chose to, we could actually, the trader might just choose to sell the put at that point. If they think, oh, that's all the bleeding that's going to happen, they could sell the put if it's a good liquid option. Let's assume they can get out for 45 cents more than they paid for it. And that takes some of the sting out of losing $1 on that contract. So this is what I refer to as the initial, or that first dollar hedge on the option. And we can just look across each of the different strike prices, and you'll notice it's different. What if we wanted a stronger initial hedge? What if we wanted to hedge 66% or 75% of that first $1 move down? That's going to cost more. So you'll notice that that's associated with, if we go for, let's say we go from this 45% initial protection or initial hedge, we go to the 56 initial hedge. Oh, that's a little bit better. Well, that's also at the 310 strike, which is giving us the right to sell our shares at a higher price. The combination of those factors is giving us a greater cost. If we want the right to sell the stock at a higher price, while also providing a stronger initial hedge, those are benefits. Those benefits come at a cost. And it's a substantial increase in the cost. It actually is about 50% more just to move up to that 310 strike. So we have the length of the contract, that affects the price of the contract. We have the strike price that's selected. Which price do we have the contractual right to sell the shares for? And we have the initial hedge. And I always, one final point on the initial hedge is that it changes. So the reason that this 310 is more expensive than 300 is because it's allowing us to sell the shares at a higher price. We can sell the shares for $310 where they're only worth 301 right now. It's like $9 of additional value there. Well, if price goes down, let's say that our stock fell to 290 after we purchased the $300 puts. So we have the right to sell at 300. Now the share's only worth 290. There's $10 now of an advantage. We can now sell the stock for $10 more than it's worth. That would actually be the equivalent of being, at the 310 strike initially. Guess what that would deliver? At that point, our delta would be higher. As a contract goes deeper in the money, the delta grows and the degree of protection on the next dollar move grows. So that's I just wanted to know that it's not always 45% on each dollar. It'll be 45 on maybe on the first one, 46 on the next one, 47. I'm just using round numbers as an example. But yeah, as the stock drops, the degree of protection grows until it ultimately gets to a 1-to-1 dollar for dollar ratio. So those are three key considerations. And really what they're leading us to is just the cost of the contract. How much, if we're looking to strike a balance between benefits and cost, then those add up to four considerations. These three benefits add up to finally the ultimate cost of the contract. So our trader here might not just be looking at the strike. They might not just be looking at the number of days till expiration. They might not just be considering the degree of initial hedge. They might also just be considering, does it seem to be worth it to them to spend this much money initially? Now, just to give you a little additional context for this, we're thinking about spending $13 per share to lock in a sales price. So we have the contractual right to sell for $300 for the next 38 days. Maybe it's a fair question to ask, well, how much might the stock move over the next 38 days, given all the factors that we've just considered? How might we get a gauge of that? It's just an estimate, but what number might we look at to get a gauge of how much the stock might rise or it might fall over the next 38 days? Well, over here to the right, you'll see there's a percentage, but this number, plus or minus, it says 31, sometimes referred to as the market maker move for the time frame of this contract. Another way that we might look at this number here is that over the next 38 days, according to the current pricing of options, traders are anticipating this stock might move as much as $31 up or down. If it moves $31 up, it may turn out we just didn't need this hedge. We might lose much or maybe even all of its value, but at least our stock went up $31. And obviously it may not, but that's sort of the upside potential of this stock. Now, that's only an estimate. Obviously, the stock can rise further, but this is giving us sort of a general range. What about to the downside? What if the stock fell $31? Ooh, that would have us down around 270, but we would still have the right to sell our shares for 300, and we'd have a $30 benefit from that $13 put. Now, obviously, it could fall further than $31. Yes, this is just a mathematically determined potential range based on how much traders are paying for options right now. Just extrapolated from that. But I think you can see that this can show why some traders might be totally fine with paying the $13. It may just make them feel more comfortable through this, what they might see as a very volatile period. Now there's a risk. It might turn out that we don't need this protection. If the stock just decides, well, we just break through this resistance, earnings goes well, October is a nothing burger, and trade tensions and all other things just sort of settle out. If the stock just goes higher, it might turn out the protection was unnecessary. And at that point, once the trader gets clear of what they think are the moments for concern, maybe they just choose to sell that protection when they don't need it anymore for whatever they can get for it. Probably can't get $13 for it anymore. Maybe they can go get $3, $2, $5. Probably going to be less than what they paid for that protection at the moment they choose to exit it. All right, but let me just place this trade. And as I do, chat it. Let me know if I've missed anything that you think I should discuss, any questions that you have about buying protective puts. But here's the process for buying a protective put. Really, all we have to do is make sure that we're buying it in the same account where the stock position is held. We don't have to tell the system, hey, this is a protective put. There's nothing special about it, like a special label it has to carry. We just have to go in and buy the same number of puts to cover the intended number of shares. So in this case, we have 100 shares, so that requires one contract, since these are standard contracts. Let's go to the $300 put. Let's click on the ask price. And let's make sure that this is just for one contract. We don't need to protect 1,000 shares. We're looking for a hedge on 100 shares. So we'll change that to 1. Buying the $300 put. Looks like it might not cost us $13. It might only be $12.85, $12.80 right now. Why is this put becoming less expensive? Well, because the stock price is going up. As price goes up, the value of puts goes down. So that's what's happening here. Let's say that we're willing to spend, you know what? Now let's leave it at $12.80. I'm going to click confirm and send. We're going to put in order to buy one GE 21st of November $300 put for $12.85. That's our limit. Now, even if we feel like we're being generous, saying that we're willing to pay up to $12.85 at a time when that looks like that's the natural on this, or in other words, basically the market price on this, it doesn't mean that that's what that we're guaranteed that we're going to be able to buy that contract for $12.85. But if we do, there's a 65-cent commission. So that brings the total cost for this protective put, $12.85.65. I'm going to send that order off and see if we can get that. Yeah, look at that. We bought it right at $12.85. So guys, that is it. We've actually, let's see. David says, is there a lesson for options trading without the goal of buying or selling the stock, but only profit or increase of options premium? So it's a good question, David. And essentially, most of our options trades placed here have exactly that objective. In this case, the trader isn't necessarily targeting getting rid of their shares. If the stock were to collapse, let's say the stock dropped to $12.80. To $2.80. If the stock fell to $280, well, we'd have the right to sell those shares for $300, but is it in the trader's best interest to actually do that at that point? Mathematically, typically not. Typically, the trader would be better off to sell the put, which is very likely worth at least, well, it is worth at least $20 plus possibly some leftover time value. So more than $20 of value in the put if we were to sell it at that point. And then we could actually sell the stock, even if we wanted to, sell it at $280. If we sell the stock at $280, but we've captured more than $20 from the sale of the put, that would be the equivalent of selling actually a stock for more than $300. So Josh says, Cam, I get stuck on protected puts. When you look at the break even, I can sell the position now higher than the protection provides for. I get the idea of the insurance in case the stock falls. And insurance is a tough word. It's not actually a perfect analogy to call this insurance. So we'll typically refer to it as a hedge instead. But in any case, but yeah, what is the break-even point on this trade? Well, if we paid $12.85, right? Right. Oh, well, look at that. It was at 301.85, but basically we have the right to sell the shares for $300. And if the shares, let's say the shares go down to 290, well, that's nice that we have the ability to sell the shares for, $10 for more than they're worth, but we paid $12.85 for that protection of $10. At that point, we probably would have been better to not have purchased the protection in the first place, right? If we're talking about exercising the contract. And that's one point I should make there, Josh. When we're talking about break even on options trades, the assumption always is that we've allowed it to go all the way till expiration. All right. So if we're at expiration and we're about to sell the shares, well, the put actually hasn't done us a net benefit. We paid $12.85 for what turned out to be a $10 savings. That's actually a net loss of $2.85. So we need to see a savings of at least $12.85 on the stock to compensate for the cost of the put. So that would be, in this case, $300 minus $12.85 would put us down at $287.15, right? Would be the break even there at expiration. Okay, Juan says, where can I learn about? So you want to learn about futures? I can show you that. I don't talk about that in this webcast. So let's see. Ignacio says, could we place a protected put in a different account from where the actual stock is? What's the risk? Actually, technically, yes. Yeah, if we have them in different accounts. The difficulty there is that we wouldn't be able to actually sell the same shares unless we transfer them to the new account before the expiration. In that case, we'd have the right to sell shares that are in another account. Yeah, you can see how that would actually maybe result in maybe a short position in one account. We'd have a long position in the other account. That's it. David, you like all this? Very good. Excellent. All right. Anyway, let's see. Did I miss something else? Was I about to do something else? I want to make sure that we don't wrap this up. It's a lesson. Oh, yeah. Somebody asked about some other topics outside of this one. Well, that brings me to a very good point. Just to make sure that you're aware of and taking advantage of the full slate of educational offerings from Schwab. If you have an interest in something outside of protective puts, well, make sure that you're subscribed to our Trader Talks channel. That's step number one. Is if you're just watching this for the first time, if you haven't subscribed to our Trader Talks channel yet, do that now. You can go down, click on the subscribe button. It doesn't cost anything. It only takes a second. But our Trader Talks channel is where we house our live streams, but also our playlists for all of our webcast series, with a few exceptions. Just a few are not actually posted here to the playlist, but the vast majority are. So, for example, if you wanted to find the playlist of archives or recordings for this webcast series, you go to playlists, and you can scroll right down toward the bottom, and you'll see there's getting started with options, and you can click on view full playlist. There's last week's discussion, the week before. That's how you can get caught up and expand your knowledge on other beginner options, strategies, and concepts. But if you had an interest in something else, what you can do is just, as you're scrolling down through here, look for those other key terms. So like if you're interested in futures, look for futures. All right. Now, another suggestion is that if you have an account with X, you should be following your favorite presenters on X. So you can follow James there on X at James Boyd CS. You can follow me on X at Cameron May CS. But this is where we can have little interactions. So, for example, Rachel, who is the newest member of our team, just joined the team a couple of weeks ago, just posted this on X, this apparent cup and handle pattern on silver. So I just asked my followers, hey, what do you think is likely to happen here? Is silver about to break out? We'll see. So we're having sort of a back and forth there. If you reply to one of my posts on X, I try to reply right back to you. James is extremely active on X. So yeah, give us a follow there. Best place to connect with your presenters in between these live streams. But that's really going to do it. We've accomplished what I set out to do today. I wanted to talk through, what's going on with the markets and why hedging might be top of mind for some traders out there. I wanted to talk through what a protective put is, and then 4 key considerations before buying a protective put. So we talked through those. We bought a protective put on an example position in our paper money portfolio. And this is what we do on Tuesdays. So if you enjoy this topic, well, if you enjoy just topics relating to getting started with options, join me on Tuesdays or watch the Tuesday archives. That's great too. Now, another thing that I want to suggest, maybe that's my final thing, and that is there is a survey out there in the chat for the live stream attendees. If you're here, just click on that survey link. You can now give me some honest feedback about how you feel like the discussion went. I'll just tell you this: if you fill out that survey, I will read that data. I look at that data and I read through those comments. It's always helpful. Never a wasted effort to fill out a survey here at Schwab. So thanks for doing that for us. James, thanks for helping out in chats. Thanks to everybody who's already clicked the like button with 165-ish people watching right now. I can see that we've had 61 that have already clicked the thumbs up. That's great to see. I always appreciate the little pat on the back there. But clicking on the like button, clicking on the thumbs up also gives a boost to my video in the YouTube algorithm so more people can find these discussions about learning things like protective puts. All right. Thanks, guys. Hey, go have a great day. James, thanks for helping out in chat again. I will look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.